Let's bring in Paul Ciana, head of technical research at BofA Securities. Paul, good to have you on. So maybe not a one-day blip. What would you be watching from here to figure out if it's vulnerable to something more on the downside?
Sure. So the S&P, the Nasdaq, the Dow, the sell-off on Friday definitely took out some of the, medium-term supports that have been guiding this up move over the last about 5 months. So I think markets are focused on likely 50-day moving averages and trailing lows over the last month or two. So about 65.50 was the lows on the last two dips in the S&P 500. So I think coming into the the full sessions over the next few days, if those levels are holding, it could be a little encouraging for the bull market to reestablish itself here. But if we start to roll over and break through that, then there's likely some more tactical pain to come.
I know that you've been focused, too, on maybe some of the indicators in the market, even before we got Friday's sell-off. In other words, the breadth of the rally, whether momentum was really holding up, and what does that look like right now? And I guess, how should we monitor things from here on out?
Sure. So the breadth looks terrible, right? It's an AI boom, and that's what's carrying the S&P 500 to higher highs. If you were to look at the New York Stock Exchange advanced decline line, you would see that cumulative line has not made a new high for many months, which means there's fewer and fewer stocks carrying the index to higher highs. Same thing goes with the percentage of stocks trading above the 50-day moving average for the S&P 500 members. That's been declining. So when we see breadth that's weak like that, we know that the support for the index overall is being driven by less stocks, and that's discouraging. That's why we've hinted at buying some tactical hedges into new highs in the S&P, because days like Friday can materialize, and October is one of those months where it just kind of tends to happen.
Right, exactly. Yeah, eventually you're due for something that the market can't quickly rescue through rotation. I'm interested in your you're looking at maybe a bit of a relevant analogy to the market right now, which would be this kind of 2015 through 2018 period for stocks, and which would place us somewhere late 2018, right? We had like a early year nasty sell-off. We also had one of those in 2018. Talk to me a little bit about what that would indicate.
Sure. So one of the analogs that we compare this particular bull cycle to is 2022 to 2025, right? To that of 2015 to 2018. And in 2018, at the start of the year, we had a big drawdown, a smaller drawdown of about 10%. Then we had a rally to new highs, and then we had a big drawdown at the year end of about 20%. This particular year, we had that big drawdown in the early part of the year, a rally to higher highs, greater than 2018 in percentage terms. And so the risk is the rule of alternation in technical analysis, where the size and sharpness of corrections tend to alternate, which would mean the risk is a 10% correction, let's say, into year end or early Q1.
Got it.
That's something that is appealing to maybe hedge out a little bit.
Yeah. Real quick, I do want to get you to weigh in on these absolutely high velocity moves in gold and silver, and whether they look like they're worth chasing.
At this point, Bank of America, we like to say responsible growth, right? And it is not responsible, in my view, to buy any chart with an RSI on a monthly basis that's above 90, right? So these are not trends really anymore. They're parabolic, right? Silver, gold, platinum, we've talked about a number of times on the show this year, going higher, right? So, in that vein of thinking, you're trailing your stop, you're trying to stay long for as long as you can, and you're fighting essentially every statistic that says the likelihood of a correction, at least in the short term, is very high. Mm-hmm. If you can weather a dip with your trailing stop-like strategy and continue to ride gold, let's say, to 4,500, all the better. But when momentum, distance from moving averages, systematic signals, wave process, and all of these things are lined up in a way that say, let's go find the next chart where the monthly RSI is going to go from 50 to 90, because that's likely an easier place to be than in a chart that's already there.